Welcome to quick revision of Accounting Standard 7 Construction Contract. Though the name of this standard is Construction Contracts, I personally believe this should have been named as Revenue from Construction Contract, because what the standard tells us is the contract which runs over more than 1 year. You need to understand how much revenue to recognize in each of that year, how much expense to recognize in each of that year, so that you will identify how much profit is to be recognized from this contract in each of the year. And this is the objective of the standard. This standard is applicable to all of them who are contractors and who are into the business of construction. Then comes the definition or meaning of the word construction contract. Construction contracts are contracts which are specifically negotiated for one single asset construction or combination of assets construction, which are interrelated or interdependent based on design, technology or function. And these construction contracts need not include material in all the cases. If in case you are giving only architectural service, which is a service contract, that is also part of construction contract, that is also regarded as construction contract. And construction doesn't just mean building ground floor, first floor, second floor. Sometimes demolition of that or the ground which is dug up, if you are restoring that, that is also regarded as construction. Construction contract includes service contracts. It will include contract for destruction or restoration of assets or restoration of environment, like restoration of a mining site to ground level. Understood? Then what are the types of construction contracts that we have? Based on the revenue, construction contracts are two types. One, fixed price contract. Second one, cost plus contract. Under fixed price contract, as the name says, the price is locked. The contractor is supposed to receive a fixed price. Contract is supposed to pay a fixed price. However, it is subject to escalation clause. Lot of things after entering to the contract, before you complete the contract, will change. So they can enter into an escalation clause which states that if the total cost goes up by more than 5%, revenue can be increased by 5%. So that clause which will trigger the increase in the revenue on happening of certain things is called as escalation clause, and this will be there in fixed price contract. Because of uncertainty involved, if the contractor is not able to quote the fixed price, that will almost lead to a point where they cannot enter into an agreement at all. That's where the savior comes, which is called as cost plus contract. In cost plus contract, contractor and contractee agrees upon an agreed percentage, which is the profit what the contractor will make over and above the cost. So as and when the cost is incurred, it will be total. On that cost will apply one percentage. That percentage is the profit, which when it is added to the contract cost incurred will become the contract revenue, and such contracts are called as cost plus contracts. You can have a combination of both also when it is agreed between contractor and contractee. As I mentioned some time ago, the recognition of profit or loss is the objective of AS7. It will tell us how to recognize revenue, how to recognize expense. From revenue, when we deduct expense, we will get the profit. Recognized revenue minus recognized expense will be the profit to be recognized. However, there is a small extra point to be noted against this, that is para 35. I'll discuss that slightly later in the same video. Now it's time to understand what do we mean when we say contract revenue and what do we mean when we say contract expense. Contract revenue, the money that the contractor will receive from the contractee for the construction, has to be recognized when it fulfills two important conditions. Number one, when there is reliable measurement. Number two, when there is probable result. Only when these two conditions are fulfilled, the contractor should recognize the revenue. Otherwise, he doesn't. What do you mean by reliable measurement? We'll discuss that later. For now, how do we determine what percentage of the contract is complete? Is done by way of cost incurred method. So the method that we're going to use throughout our CA intermediate discussion of AS7 is called as percentage completion method. We don't follow total cost method. You might get some questions wherein they might say that the contractor wants to follow total contract cost. That is not allowed. We follow percentage completion. Every completed year, we determine what percentage of the contract is complete, and that percentage of the contract revenue will be recognized in P&L. And that percentage of contract cost is also recognized. So we'll identify that percentage of contract profit in contract PL. I hope you're getting it. How do we determine that percentage? We take cost incurred divided by cost incurred plus to be incurred. That is total cost. Cost incurred divided by total cost will give us percentage complete. There are a couple of other methods which I'll refer slightly later, but they are not supposed to be followed in exam preparation. Then contract revenue, what does it mean? It will include such revenue what the contractor and contractee has agreed upon in the agreement. Over and above this, there are certain things that you should know. Variations, claims, incentives, penalties. Variation, other than the scope that is decided in the agreement, if the contractor gives extra service or if the contractee asks the services to be brought down, to the extent they are going out of the scope, contract revenue will be altered. Variation can be upside, variation can be downside. Contract is for construction of 4 floors. Contractee might ask the contractor to build 1 more floor, or contractee might ask the contractor to build 1 floor less. If you have to build 1 more floor, contractor will add the revenue. If you have to build 1 floor less, contractee will ask for decrease. That plus or minus is what we call as variation, which is arising because of change in the scope. Next one is claim. What do you mean by claim? If in case contractor incurs the expenses over and above what is supposed to be incurred in the agreement, for such expenditure, contractor will take reimbursement from contractee. That reimbursement of the expense incurred by the contractor, which is taken from the contractee, should be added to the contract revenue as per agreement. After that, we have something called incentive. If the contractor gives the performance beyond the standard set as per agreement, I finish the construction before time, or I give the service more than the service level I promised, so you will be happy as a contractee, so you give me incentive. Such additional consideration received by the contractor for better performance, maybe time or maybe quality. Either of it, if it is becoming better, contractee gives additional consideration that will be included in contract revenue, and that's called as incentive. Finally, we have penalty. As a contractor, if I don't finish it in time, if I delay completion, or because of me you are paying some fine, or because of me you are facing some loss because the quality of performance is low, you will charge me some penalty. You will deduct a portion of my consideration and give me only the balance. That portion what you deduct is called penalty. So the contract revenue that should be treated by the contractor as his revenue is revenue as per agreement plus or minus variation plus claim plus incentive minus penalty. And this is what we mean when we say revenue. What do we mean by contract expense? As a contractor, we directly incur some expenditure for construction, that is contract cost. We indirectly incur some, meaning we have incurred some joint expenditure for several contracts together. One engineer who works in 3 construction sites, so that one engineer's salary is to be allocated to all the 3 construction sites proportionately. If I allocate, that allocated cost also becomes part of my construction cost. Thirdly, any other cost. Let's say I have one machine which I'm using for all the construction sites together. Based on the time usage, I'll allocate that overhead expenditure. That is depreciation on that machine or repairs and maintenance of that machine. That also becomes part of my contract expense. Are you getting it? However, if that asset that we have, which is charged to depreciation, is idle, meaning that asset is not used in construction site, then the depreciation cannot be added to the contract expense. Similarly, if there is general administration expenditure, selling and overhead expenditure, research and development expenditure, all of this should not be included in the contract cost. They should be straight away written to P&L. It will not go to contract PL. It will go to general P&L straight away. And then the part is, before you get the contract, if you have incurred some expenditure, it is called as cost incurred to secure the contract, and it can be included into the cost of the contract but need not be. The basic thumb rule is, before you get the contract, if you incur expenditure, that should go to P&L. However, paragraph 20 of accounting standard 7 gives a very beautiful situation, because of which we can include some cost incurred before the contract into the cost of the contract. To do that, it has to fulfill 3 important conditions, IMP. I. What is I? Identifiable. You should be able to identify that expenditure to be related to this contract specifically. Second point, that cost should be measurable in terms of money. Third point, probability of getting the contract should increase because of this expenditure. In such cases, this expenditure what is incurred even before you get the contract need not be transferred to profit and loss. It will be kept with you and added to the cost of the contract. Am I right? After this, we'll discuss how to recognize the revenue. I told you revenue has to be recognized when there is reliable measurement and probable result. Now the point is, if the revenue can be reliably estimated, then we will recognize based on percentage completion method. However, if the revenue cannot be reliably estimated, cost will anyways be recognized when it is incurred. Revenue recognition will be postponed till the time you have reasonable certainty or reliable measurement. Only on the day when you get reliable measurement, you will recognize the revenue, otherwise no. To summarize this recognition of revenue in one shot, cost will be recognized the moment it is incurred. Revenue will be recognized only when there is reasonable certainty or reliable measurement of the revenue. The question that comes next is, how do we get to know whether there is reliable measurement or not? How do we get to know? Very simple. Reliable measurement has to be made based on cost incurred and cost to be incurred. When you get cost already incurred, that will be known, plus cost to be incurred, if you know, you get total cost. When you get total cost, you will find percentage of completion. When you find percentage of completion, you will multiply it with total contract revenue to find the contract revenue to be recognized. If in case you cannot identify cost to be incurred, you cannot find total cost. When you cannot find total cost, you cannot find percentage. When you cannot find percentage, you cannot identify revenue to be recognized in the year. In that case, what do? There is no reliable measurement. It cannot be estimated with certainty. Then we recognize our expense to P&L, but revenue will be postponed till the time there is reasonable certainty. This is how it works with fixed price contract. Under cost plus contract, there is one more thing that you should know. What is that percentage of profit that you should add to the cost? Only when you know cost incurred, to be incurred, you will find percentage. Only when you know that percentage of agreed value over and above cost, then you will be able to recognize contract revenue to be recognized in the current year. Otherwise, no. Then the point is stage of completion. I told you stage of completion is computed under three methods. One is cost incurred to total cost, what we follow. The other method is survey method. Next one is physical proportion method. We don't follow survey method and physical proportion method. That is work certified thing. We go by cost method. That is cost incurred divided by total cost multiplied by 100. Then comes the most important part of the standard, which is para 35 of accounting standard 7. Para 35 states that at any point of time, if the total contract cost exceeds total contract revenue, then you are going to make loss, no, in total. Total contract cost is greater than total contract revenue. Entire loss should be recognized, irrespective of the fact whether a contract is begun, irrespective of the stage of completion, irrespective of the profit from other contracts. Contract revenue is recognized based on PCM. Contract cost is recognized based on PCM. If there is loss that comes in P&L will be percentage only. But you should write total loss. If you write total loss, to the extent loss is not yet incurred, because the contract is not yet complete, will be called as provision. What you have to do is open contract PL, PCM percentage multiplied by total revenue, write credit side. Contract cost incurred or total contract cost into percentage, you write debit side. Don't write proportion loss. Write total loss from the total contract revenue and total contract cost on the credit side. Find provision as balancing figure on the debit. I hope you got it. If in case there is any cost incurred relating to future activity, we have paid the expense but benefit is not taken. I bought material for 25,000. Material used in construction is 20,000. 5,000 worth of material purchased but not used will be transferred to next year. So in the next accounting year, we will recognize that 5,000 as expense. In the current year, that 5,000 will become asset. So to the extent cost is incurred but benefit is not consumed, will be postponed to next year only if it is probably recoverable in the next year. That's with regard to cost relating to future activity. Then we have uncollectible revenue. If we think that we might not receive the revenue at the time of giving the construction service, we will not recognize the revenue only. Why? There is no probable result. We think our contractee will not give us money, we will not book income. However, at the time of giving the service, there is reliable measurement and probable result. So you recognize the revenue. After that, you got to know that contractee will no longer pay you the money. What will you do in that case? Then revenue which is already recognized will be reversed. And then we have combining and segregating contracts. See, if negotiation can be done separately, cost and revenue can be identified separately, profit can be determined separately, then they have to be treated as two separate contracts, not as a single contract. But these two assets will be treated as a single contract when what we discussed in definition is important. By design, technology or function, they are interrelated or interdependent. Understood? Then the estimate keeps changing. We estimated some amount to be the total cost in year 1. That need not be the same. That can change in year 2. That can change in year 3. Both upwards as well as downwards. When that changes, then the amount of expenditure to be recognized will change. Percentage of completion will change, as well as revenue to be recognized will change. Whenever this happens, it is change in accounting estimate, not a prior period item, not a change in accounting policy. More of this you will read in accounting standard 5. Disclosure requirements. Whenever you are running a contract, you need to tell what percentage of the contract is complete, what percentage of revenue is booked, how are you recognizing that percentage basis, and how much money have you received, how much money is yet to be received, how much money have you received excess. All of these have to be disclosed. If in case you have collected the money before completion of the contract, it is called advance. If the service is given but the contractor has not paid us the money, keeping it with him because he wants to check the work, it is called retention. And finally, you have raised the billings before the completion of the contract, that bill is called as progressive billings. And lastly, the questions can come asking you to determine asset or liability. Asset or liability is determined like this from the customer. You have to recover the cost incurred plus profit from your customer. If there is loss, that loss will not be reimbursed by the customer. So you take cost incurred, add the profit recognized, deduct the loss recognized. When you do cost incurred plus profit recognized minus loss recognized, you will get the amount to be charged. If the amount to be charged is more than the billing made, you have collected extra liability. If the amount to be charged is less but the billing made is more, then you have a liability, you charged more. If the amount to be charged is more but amount of the billing done is less, it is asset. This can be done slightly differently. Mathematics, what to do? Take cost incurred, add recognized profit, deduct recognized losses. From this, if you deduct progressive billings, the resulting number, if it is positive, it is asset. If it is negative, it is liability. Once again, expense incurred plus recognized profit minus recognized loss minus progressive billings. If the resulting number is positive, it is asset. Negative number, liability. So amount due to customers is liability. Amount due from customers turns out to be your asset. And this is accounting standard 7.